Hey guys, it's Anthony. Did you know your hard-earned money is losing value every year? Inflation is silently eating away at it, but the good news? Investing is the solution. Imagine your money working for you, growing, even while you sleep. Whether you're saving for the future, building wealth, or just getting started, investing is the key to making it happen. In this guide, I'll walk you through exactly how to start investing, step by step. From key concepts, to building your portfolio, to managing your investments, I'll help make investing simple and easy to understand. By the end of this video, you'll have everything you need to get your money working smarter. So come along with me, let's hang out. Let's jump in and get started. My goal is that by the end of this video, you'll be able to confidently invest and start making your money work for you. No prior experience is needed, and I will simplify everything. I'm sharing key insights and valuable lessons from my own investing experience and the best investment knowledge out there. But I'm only focusing on what truly matters. I know your time is valuable, so this guide is packed with the essentials to get you started quickly. If I do go too fast, feel free to pause, rewatch, or take screenshots as needed. Here's how the guide is structured. No prior investing knowledge is required. This is beginner friendly. That said, I've also included insights that more experienced investors may find valuable. While this guide focuses on easy to access assets like stocks and ETFs, many of the principles apply across different markets and asset classes. Now, quick reminder, investing and trading involve risks, so be sure to read the disclaimer in the description before making any investment decisions. Chapter 1. Why invest? The power of growing your money. But before we get into that, what exactly is investing? Although investing can pertain to many things, in this context, we think of investing in terms of money or wealth. And in that sense, investing is simply the act of putting money into assets, like stocks, with the expectation of earning a profit or increasing in value over time. The goal of investing is to grow wealth. So now that we're hopefully on the same page, why is it a good idea to invest? Well, there are a few good reasons. There's inflation risk. Inflation slowly eats away at the value of your money. Over the past year, the inflation rate in the US has been between 2 and 4%. It peaked at 9.1% in June of 2022. This means things cost that much more compared to the previous year. And over time, these increases compound, making your money worth less and less. So simply saving your cash isn't enough. It still loses value over time. Investing smart helps you outpace inflation and preserve your hard-earned money. Then there's compound interest. Compound interest is when your money earns returns, and then those returns earn more returns, helping your savings or investments grow faster over time, year after year. Let's look at an example. Say you want to invest $300 as your initial investment, and you assume a modest return of 10% every year. Here's how it breaks down every 5 years. The return went from 10% in the first year to 60% after 5 years, and 160% after 10 years invested. This exponential growth is the power of compound interest, and this is an extremely modest example using no additional monthly deposits. Many of the strategies I'll show later on will likely yield even better returns than this. And don't worry if that feels like a lot of numbers. The main takeaway is this. With time, your investments will continue to grow and build on themselves. The earlier you start, the more time your money has to grow exponentially. Top investor Warren Buffett stresses the power of investing early. He uses a snowball analogy to illustrate how wealth builds over time, just like a snowball rolling downhill, growing bigger as it goes. He says, I packed my little snowball very early, and if I had packed it 10 years later, it would have been way different than where it stands on the hill right now. If you start out a little ahead of the game, it doesn't have to be a lot, but it's so much better than starting out behind the game. So that's the importance of compound interest and the benefits of starting early. Finally, investing can be the key to achieving your personal goals. Are you aiming for financial freedom, saving for retirement, or maybe building wealth for a big milestone like buying a home. Investing can make your goals more attainable and help you make progress towards what matters most to you. So when is the right time to invest? Before jumping in, there are a couple of important steps that should be taken care of first. The priority should be paying off any high-interest debt. Focus on clearing credit cards, personal loans, or any debt with high interest. Next, build an emergency fund. Set aside enough to cover unexpected situations like job loss or emergencies, and keep it in a high-yield savings account for easy access. A high-yield savings account returns some interest that is lower than inflation, but higher than most traditional bank accounts, so they are often the best place to stash your cash to keep it safe. So if you haven't done most of steps 1 and 2 yet, you might be better off focusing on those first before moving on to investing. And once you've taken care of steps 1 and 2, then you'll be in a really solid position to start investing, and you can invest with confidence. Chapter 2: Demystifying the World of Investing. Now let's break down some of the key terms you'll need to get started on the right track. First off, assets are what you invest in, such as stocks, bonds, ETFs, or real estate. If you own a share of company stock, that share is your asset. Assets can also be commodities like metals, oil, and physical products like shoes, jewelry, baseball cards. As long as the underlying price can change, they could make investment assets. But moving forward here, we'll mainly refer to stocks and ETFs as the asset, but just know that most investing principles here can also apply to many different assets. Number 2, portfolio, the collection of all your investment assets. We'll show you how to build your stock portfolio later on in the video. Unrealized gains and losses, the change in value of an asset you own but haven't sold yet. For example, if you buy stock and its price increases, that increase is an unrealized gain. You haven't technically locked in your profits until you sell. Same thing with losses. And so when you do sell, that becomes a realized gain or loss. This is just a fancy way of saying that you haven't sold yet. Time horizon, how long you plan to hold your investments before needing the money. Knowing your time horizon helps you plan accordingly so that your investment strategy fits your situation and goals. Market volatility, the ups and downs in the market or asset's price over time. It's normal for market volatility to fluctuate. During periods of high volatility, the key is to be prepared and not be reactive to the short-term news or sentiment. Now, it's important to note the distinction between trading and investing because they're similar, and sometimes people use the terms interchangeably. But a general distinction investors use between trading and investing is the longer time horizon of investing. In trading, you'd buy and sell, holding the position over a short time horizon like days or hours, whereas with investing, you're generally buying and holding an investment position for multiple years. Chapter 3: Laying the Foundation, Planning and Risk. Define your own investment budget in terms of how much of your income you will contribute into investing. A common budgeting strategy is the 50-30-20 rule, meaning 50 goes to needs like your monthly rent, car payment, groceries, your essentials. Then 30% for wants, fun stuff like dining out, vacations, or your subscription services. Then 20% for savings. This is where your investments would fall under, and generally includes budgeting towards the future. Now you can adjust these percentages any which way that works for you. I'll leave it up to you to decide. Just remember, the more you invest early on, the faster and easier it will be for your money to compound and grow. So, once you've decided how much you're going to set aside for investing, you'll want to figure out your time horizon, the amount of time you're planning to invest before needing the money. If you're in your 20s, you likely have a longer time horizon, which gives your money more time to grow. Maybe you want to buy a house by 35 or aim for early retirement by 50. You can set multiple time horizons for different financial goals. Now, if you're someone who's older, like in your 60s, your time horizon might be shorter, like 10 years. Now, important note here, this guide focuses on regular, non-retirement investing, money you can access at any time. This is much more universal. If you are investing for retirement, many of the same principles will still apply, but retirement accounts come with age-based withdrawal restrictions, so it's good to be aware of that. Quick background on the stock market. This is why the S&P is a good hedge against inflation long term. If we go back to the S&P chart, you'll notice the volatility. Some years the price might go up 20%, some years it might go down 10%. It doesn't return 10% exactly every year. That would look like a straight line going toward the upper right. The reality is that price fluctuates up and down. There were some years you might have invested and might have lost money, but assuming you didn't sell, those would have only been short-term unrealized losses. If you notice, the chart still generally goes up to the right. So if you had invested most of the previous years, you would currently have gains if you held those investments up to now. This shows why the S&P 500 is a good long-term asset to invest in. Next, we need to understand risk and reward and the trade-off between them. For the most part, higher risk investments can lead to higher returns, but also bigger losses. And lower risk investments can lead to smaller losses and more stability, but they also come with lower return potential. These are the trade-offs, but just like we saw with the S&P 500 chart, much of the short-term risk is reduced when investing for the long term. After we understand the risk and know our time horizon, we'll want to figure out the level of risk that we're comfortable taking on. So for example, if you're in your 20s with a 30-year time horizon, you might consider higher risk assets like individual stocks for higher profit potential. With a long time horizon, you have more time to recover from market dips, which helps smooth out short-term volatility. Now, if you're older with a shorter time horizon, like 10 years, you might prioritize safer, lower risk assets like bonds to protect yourself from short-term volatility. Your personal psychological risk tolerance can be tricky to figure out, especially when you're just starting. One way to gauge it is by looking at your initial investment amount, your starting capital, and seeing how you'd feel during a market drop. For example, let's say the market drops 20%, which happens from time to time. If you invested $100, a 20% drop means you're down just $20. Not great, but manageable. Now, if you invested $10,000, a 20% drop is a $2,000 unrealized loss. It's still the same percentage, but that dollar amount feels much bigger. So, logically, a long-term investor knows that the market will likely recover, but emotionally, seeing a large unrealized loss on your account can trigger fear. That fear could cause you to panic sell, locking in losses and throwing off your investment plan. So understanding your personal risk tolerance is key. It helps guide your investment decisions and keeps you from making emotion-driven mistakes. And one simple way to improve your risk tolerance: ignore your account. Don't check it daily or even weekly. Most brokers also let you hide the dollar amount and show only percentages, which can help you stay focused on your long-term goals. Chapter 4: Setting up your investment account. First, let's go over the key investment assets we'll be covering. These are typically easy to manage through your broker, where you'll be setting up your investments. Stocks. Stocks are shares of a company that give you partial ownership. Investing in stocks is relatively higher risk, but with higher potential returns. Bonds are loans to governments or companies that pay you interest over time. Investing in bonds is lower risk than stocks, but also lower returns. They're usually available through established brokerages and not the newer ones. We actually won't dive too deep into bonds. They have fallen out of favor in the larger investment world, but it's good to be aware of them as lower risk assets that provide fixed income. Now, ETFs are a collection of stocks or bonds, and ETFs trade just like stocks. They're great for diversification with relatively moderate or medium risk. And they're much easier to manage for us retail investors than holding multiple individual stocks. ETFs have really grown in popularity over the past 20 years and may likely take up a large portion of your investment portfolio. Now it's time to choose a broker. Here are some of the important features investors should look out for. Ease of use. How simple and intuitive the platform is. Is the app's user interface clean? Are trade orders easy to place? And so on. Available investments. Does the broker offer the asset I want to invest in? For example, some ETFs are only available through certain brokers. So if you have your eye on any specific ETFs, you might want to lean towards picking that broker. Also, for bonds. Bonds are available through established brokers like Charles Schwab and Fidelity, but not through newer ones like Moomoo or Robinhood. Customer support. Customer service is always important when using a broker. Are they responsive? Are they helpful? Check out some of the reviews. Does the broker offer fractional shares? This is good for starting small. Interest on uninvested cash. Currently, Moomoo is paying you 4% on uninvested cash. Not all brokers pay you this, but it's a good bonus. Withdrawal fees. Most of the popular brokers do not have this, but as of this recording, eToro has a $5 withdrawal fee. So look out for any withdrawal fees. And then, broker reputation. This can become more important once your investments grow and you want an additional layer of safety. Finally, you might find that there is no perfect broker that will check all the boxes. You can always join multiple brokers too. Most of them are free to open an account. Now here are some of the top brokers that are great for starting out investing. Charles Schwab, Webull, Fidelity, and Moomoo. I've used all of them at some point in my investing, and I don't think you can go wrong picking any of these. I'll be doing a deeper breakdown comparing the top brokers in another video for anyone who wants to explore this further and see if any of the many broker options out there might be right for you. Now, if you're short on time, Robo-Advisors can be a great option. They handle your investments for you based on the risk level you choose. One thing to keep in mind though is that they do charge a management fee. On the other hand, managing your investments on your own doesn't cost you extra and is pretty straightforward once you're all set up. But if you prefer to go the Robo-Advisor route, then Wealthfront, Betterment, and Acorns are some of the most popular choices. So once you've picked your broker, you'll want to get your investment account set up. We'll use Moomoo here as an example. Now, Moomoo is my go-to for anyone starting investing. They have great desktop and mobile apps. Their research and educational tools are high quality, and they have great customer support. Moomoo's account opening process is quick, seamless, and fully digital. There's no minimum deposit, and verification can take less than a day. So if you decide on Moomoo, I have a referral link here for you. There's a welcome bonus, and it's free. The bonus they're doing right now is 8.1% interest on uninvested cash, which is really good, and up to 30 free stocks. And if you use this referral link, it would help support the channel. If you decided on a different broker, feel free to continue following along here. The setup process should be mostly the same with minor differences, but always make sure you understand what you're doing before moving forward. Now, while signing up, you might be prompted to choose between a cash account or margin account. In short, a cash account is just like another bank account you have. A margin account uses margin or borrowed money, like credit cards. So to be safe, choose cash account. Margin accounts use leverage, which carries additional risk. After you create your account, wait for account verification. This can be instantaneous, only taking a few seconds, or it can take a few days. It all depends on your broker. Then, one of the last things you'll need to do before you can start investing is to fund your account. You can do this on the mobile app or web browser. Now, during the sign-up process, you might have already downloaded the mobile app on your phone. If so, great. If not, no worries. You can go ahead and download the app or fund your account on the web in a similar way. But it's nice to have your investments on your phone so that you can have access to them anytime. So as you can see here, funding your account is pretty straightforward. Under your account, go to Transfers, then Deposit, and choose a deposit method. Then, once your deposit is completed, you'll get an email from Moomoo. Then, you're all set and ready to invest. Chapter 5. Building a Strong Investment Portfolio. Now comes the fun part, picking investments. But honestly, you might only need one. Warren Buffett has often said that the S&P 500 is the best option for most investors, and I tend to agree. If you recall, the S&P 500 is a standard benchmark for investing, averaging around a 10% return over long periods. Some ETFs that track the S&P 500 include VOO and SPY. If you invest in one of these, your portfolio will move with the overall market, gaining and losing just like the S&P. Let's take a look at VOO or VOO. This is an ETF you'd buy if you want exposure to the S&P 500. One key advantage, it has a low expense ratio, meaning fewer fees eating into your returns. So why consider investing in the S&P 500? First, it's tough to beat. Over the past 20 years, most professional fund managers, despite having research teams and high computing technology, haven't been able to consistently outperform the S&P. So while beating the market is possible, it's a huge challenge for most people. Second, it's already diversified. Buying the S&P 500 is like owning the top 500 US stocks, reducing your risk. If one company crashes, the index is still propped up by all the other stocks. Plus, underperforming stocks get replaced by stronger ones, and you gain exposure across different sectors, balancing out market fluctuations. Third, it's structured to reduce risk. The index is weighted toward top-performing companies, so if a company underperforms, its impact naturally decreases. And finally, the S&P 500 has always recovered. Individual stocks can crash or even go bankrupt, but the S&P 500 has historically bounced back from downturns and hit new record highs given time. That's why longer investment time horizons work in your favor. And that's it. For many people, the S&P 500 might be all you need. Investing really can be this simple. But everyone's situation is different, so it's worth going beyond a one-size-fits-all approach. Just like setting personal goals, fine-tuning your investment strategy can help it better align with your unique needs and financial situation. Now, if you're looking for returns better than the 10% the S&P averages, then naturally you'll need to take on more risk. The reasons for this will be different for everyone. Maybe you have such a long time horizon that can handle volatility. Or maybe you're starting with a very small capital and want higher growth potential. Whatever the reason, you'll want to beat that 10% average return, and you can accomplish this by diversifying into riskier assets. Here's what you can add to your portfolio for higher returns. There are growth ETFs. These focus on high-growth companies. Examples include VUG, MGK, RSP, QQM, and RPG. These generally have more volatility than the S&P, but also offer higher return potential. Let's take a look at VUG, or VUG, the Vanguard Growth ETF. We can look at the stock holdings that make up the VUG ETF. Remember, an ETF is just a collection of stocks. You might see some familiar names here: Apple, Microsoft, Nvidia, etc. Here's the allocation, the percentage that the stock takes up in the ETF. They're ordered by market value, so you can see how the ETF's allocations are weighted heavily in tech stocks. We can also examine the sector allocation here, how the collection is broken down by industry. We see about 60% in the technology sector, about 6% healthcare, about 3% financials. So there's a broad diversification of sectors, but highly focused on growth potential. Now with ETFs, also be mindful of their expense ratio. This is like a commission we pay to them to cover the ETF's operating costs. Think of it as a fee for the convenience of using the ETFs. You essentially get the benefits of diversification and rebalancing with the click of a buy button. Now, moving further up the risk curve, if you want to take on more risks than general growth, you can focus on a theme with thematic ETFs, or in other words, an industry, sector, or space. Right now, the AI or artificial intelligence sector has been dominating the markets recently. XAIX, ARTY, BAI are some AI-focused ETFs whose holdings include Apple, Nvidia, and many other companies involved with AI. You can even dial in deeper into some sub-sectors. Bots is an ETF that focuses on robotics and AI. With these thematic ETFs, they are not as broadly diversified across different sectors, so they can naturally go through much higher volatility than the general growth ETFs. Finally, for even higher potential returns, you can pick individual stocks. If you pick the leaders, you can outperform the sector. Apple, for example, has seen massive growth in the tech sector over the past 20 years. But stocks come with higher risk and volatility. Bad earnings, management changes, or market downturns can cause steep crashes. There's no built-in safety net in stocks, the way ETFs use diversification to hedge against and minimize the downside. And if you end up picking a bad company, it might not ever recover the way the S&P has recovered consistently. Still, despite the risk, the high profit potential of individual stocks is a big draw to many investors who have a long time horizon. And if you pick an established company like Apple, you would have made large returns throughout the past 20 years. One thing to note about individual stocks and diversification: if you invest in ETFs and individual stocks, you might be less diversified than it seems. For example, with Apple again, if you have 50% in Apple and 50% in the S&P like VU, your investments are actually exposed to Apple by more than 50%. Apple is part of the S&P 500, so this should be taken into account. If we look at a 50-50 Apple VU portfolio, we can see that the Apple exposure is not 50%. It's actually 54%. Just good to be aware of in case you don't want to be overexposed by that amount. Let's review. If you want to beat the S&P returns, you can move up the risk curve starting with growth ETFs, then thematic ETFs, then individual stocks. But then again, keep in mind that most investors won't beat the S&P 500, even when taking on higher risk. It is possible to outperform the market, and these are some good options to get you started. But it takes more time and effort on top of the extra risk, so it might not be worth the extra returns. Now, on the opposite end, if you want to decrease your risk, less risk than holding the S&P, maybe you're nearing retirement or saving for a big purchase, whatever the case, you'll want to keep your money safer from downside risk. Protecting your capital becomes more important than chasing high returns. A good approach would be to diversify between the S&P and a high-yield savings account so that you have a percentage invested to grow and a percentage safe in cash. Now, the high yield is like cash, so it's not technically what we think of in terms of investing, but it keeps pace with inflation, even if it's a little underneath. And there's no other downside risk. Some brokers have a form of this called interest on uninvested cash, which has similar interest rates, allowing you to keep your cash and investments all on the same platform. Let's break down the S&P and high yield mix approach. We'll do a simple 50-50 split between VU and a high yield. Now let's assume a 10% S&P average return and a 2% inflation loss from your high yield savings. This is really conservative. You probably won't lose that much. In all, you would still come out ahead and net a 4% total return. The idea here is that your S&P investment should still do enough to outpace inflation combined, even at a smaller allocation. It's up to you to figure out how much risk you're willing to take on by shifting the allocation percentages around. Now, if you want to go really risk off, you can reduce the S&P allocation further. About the safest you can go is 25% in VU and 75% in high yield savings, which still keeps your portfolio growing above inflation. If you go any lower than 25% invested in the S&P, that's roughly the point where your total capital stops outpacing inflation and your money begins to lose its value over time. Really important to keep in mind. One thing to mention, traditionally in the past, people would de-risk by diversifying with fixed income like bonds or low volatility ETFs. But these notions might be outdated. In recent years, these have underperformed compared to an S&P 500 plus high yield savings approach. No matter your risk level, the key is balancing growth and safety in a way that fits your goals. I wanted to give you more concrete examples to help you build your portfolio. Now, there's no one-size-fits-all solution as everyone's situation and risk tolerance is different, but hopefully this helps you plan more solidly. We'll lay this down using time horizon and use a baseline average risk level based on that time horizon. We can call these portfolio templates. See which one is closer to your time horizon and adjust the allocations accordingly. 30 years before time horizon. The reason we like to keep the S&P allocation high is because it's difficult to beat the S&P consistently over long periods, and it keeps our returns more stable. This allocation takes advantage of the long time horizon with a good portion in higher risk assets. Remember, this is a baseline portfolio, only based on the time horizon. To suit your personal situation, you'll need to adjust the allocations based on your risk tolerance, capital amount, and goals. If you're going with large capital, this might be too risky for you. If you need to take risk off, go down the risk curve. Take off some of the higher risk and bring it down to 5% exposure, or remove it completely. If you want to take on more profit potential, your portfolio can lean towards more stock. Just make sure you understand and accept the risk. Adjust the percentages depending on your situation. 20 years before time horizon. Here, we remove the 10% higher risk allocation, but retain the growth allocation for higher average returns. This adds some stability while maintaining a high growth potential. 10 years before time horizon. Here, we greatly reduce the growth allocation, but have just enough that we might outperform the S&P. 10 years is still a decent length of time to grow your capital. 5 years before time horizon. At this point, we're greatly cutting down our investments. With only 5 years to go, we want to prioritize safety and reduce the risk from market downturns that happen about every 10 years. So these are how the baseline portfolio should look, broken down by time horizon. You'll need to adjust the percentages based on your personal situation, your risk tolerance, and your investment capital. Want more safety and stability? Consider allocating a higher percentage to the S&P. Want to aim for higher returns? Increase your exposure to growth ETFs or individual stocks. These templates also highlight the importance of rebalancing allocation over time. As we get closer to our time horizons and our situations change, we should adapt our portfolios as well. Chapter 6. How to Pick Winning Stocks. This chapter on picking stocks is for those who are willing to take on higher risk for a chance at higher returns. For many investment strategies, the baseline and safer portfolios are the better option. So if you're deciding to go in that direction, feel free to skip ahead to the next chapter. For those with a higher risk profile or just want to learn more, let's dive in. So, when picking stocks, we want to look for financially healthy companies, ones that generate their own cash flow, rely less on debt, and are growing over time. To do this, we can look through the company's financials. You can find these on many charts and research platforms, and even in some broker apps. I like to use TradingView. I have a referral link here and in the description in case anyone is interested. Now here are some key financial metrics to consider. Cash and equivalents versus debt. This is found in the company's balance sheet. This tells us whether a company has enough cash to cover its debts. Ideally, a strong company should have more cash than debt, meaning it doesn't need to borrow much to operate. We can also look at debt to equity ratio. This is also found in the company's balance sheet or is already calculated statistics. This compares how much debt a company uses relative to its own equity, cash, and assets. A debt to equity ratio below 0.8 is generally considered healthy, but it should also be compared to other companies in the same sector. A low ratio means the company is generating enough cash to fund itself rather than relying on borrowing. Total revenue. Total revenue can be found in the company's income statement. This is the total money a company makes from selling its products or services. For growth stocks, revenue should be increasing year over year. This signals business expansion. Another number to look at is the net margin. This is the company's net income divided by its total revenue. This shows how much of a company's revenue turns into profit after all expenses are paid. A rising net margin indicates the company is becoming more efficient and profitable over time. And note, some growth companies still rely on debt while they scale. If they are moving toward profitability with rising total revenue and net margin, they could be great investments for the future. This is a good place to start when looking for strong stocks, but it's not an exhaustive list. There's a whole lot you can discover about a company through their financial statements. Another way to find good stocks is by taking advantage of the professional stock analysts. Many platforms provide analysts' forecasts, price targets, and buy and sell ratings. These can be useful tools for supplementing research, but we should still be cautious. We should not rely on them blindly. Nobody can predict the future, and these ratings can become outdated quickly once a stock's price moves unexpectedly. Chapter 7. Keys to Managing Your Portfolio. Managing your portfolio should be pretty straightforward. Many brokers allow you to set up automated deposits and use dynamic rebalancing to keep your portfolio allocations on track. You can schedule this monthly or every few months. It's really up to you, but consistency is key. Number 2. Rebalance your portfolio regularly. You'll want to make use of dynamic rebalancing, which automatically adjusts your deposits to maintain your target allocation. For example, let's say your portfolio is split between VU and growth ETFs. If your growth ETF has a strong month and its share of your portfolio increases by 2%, your broker will recognize that you're now overexposed to growth and will buy more VU with your next deposit to bring your allocation back in balance. If you prefer, you can also rebalance manually by buying more of the asset that has dropped below its target allocation. Dynamic rebalancing is automated and easier, but either way, keeping your portfolio balanced ensures it stays aligned with your strategy. Now, this method naturally incorporates dollar cost averaging, or DCA. Dollar cost averaging is an investing strategy where you invest a fixed amount at regular intervals no matter the market conditions. By investing consistently, you avoid stressing over price fluctuations. For example, as VU moves up and down over time, you're buying a set amount every month at whatever price it's at, which averages out your cost over time. It reduces the impact of volatility, and it's a proven long-term investing approach. On the other hand, trying to time the market is an unreliable strategy. If you're trying to time the market, you might hesitate to buy because the price seems high, only to miss out on further gains. Or you might wait for the price to drop, which never happens, leaving you stuck on the sidelines. Now, market timing can play a role in short-term trading, but it's not a solid strategy for long-term investing. DCA removes the guesswork and keeps you consistently invested. Once your investment portfolio is set up and running smoothly, there's really not much day-to-day management needed. Most of it can be automated, as we went over. Now, remember, we must also be aware of the psychological aspect of the markets. Market downturns will happen, so we should expect them and not panic. Ignore the fear-driven news cycle. It promotes emotional decision-making and panic selling. And once your portfolio is set up, the best thing you might want to do is just to not look at your account too often. Stick to your investment plans and goals. We should maintain a long-term mindset, thinking in years, not weeks or months. And your portfolio shouldn't need to be constantly micromanaged. Checking in every 6 months to a year is usually good enough to see if any adjustments are needed. A long-term focus often wins out. Watching your investments daily can hurt your risk tolerance and lead you to make poor short-term decisions that can derail your investments. The best approach? Stay steady, trust your strategy, and let time work in your favor. Another quick reminder. Investing and trading involve risks, so be sure to read the disclaimer in the description before making any investment decisions. Now to wrap things up, let's quickly recap the keys to successful investing. First, build your portfolio with a strategy that fits your time horizon, risk tolerance, and available capital. Everyone's situation is different, so your portfolio should reflect your personal goals. Next, stay consistent. Automating your deposits and portfolio rebalancing keeps your investments on track without overthinking every market move. And finally, focus on the long term. Investing is a marathon, not a sprint. The market will have ups and downs, but staying patient and sticking to your plan is what leads to real growth over time. Stick with these principles and you'll be well on your way to long-term success. Now, before we close out the guide, here are some of the resources we used or mentioned. If you're interested in Moomoo or TradingView and want to support the channel, consider using the referral links here or in the description. This video is not sponsored. I just really like the services they provide and find them extremely useful. So that's going to do it for us for this guide on investing. Great job if you're still with me and stuck through it. We covered quite a bit, so if you have any questions, drop them in the comments. Investing can really be as simple as building a portfolio, staying consistent, and focusing on the long term. And now you've got a solid foundation, everything you need to have your money working for you, growing while you sleep. For some of the topics we touched on at a high level, I'll be doing deeper dives in future videos, so stay tuned for those. And if there's anything you would like to see on the channel, let us know in the comments. Thank you guys so much for watching. I'm hoping you found this helpful and learned something new. If you're new here and want to explore more about investing or trading, please consider subscribing. It really helps support the channel. I had so much fun putting this together. Thanks again, and I will see you in the next one. Take care.